The market for digital real estate operations is navigating a unique period of friction, and Opendoor Technologies is currently sitting under a bright spotlight. If you look at the board right now, the stock market is closed for the session, and Opendoor, trading under the ticker OPEN, finished its last active trading window at exactly $4.38 per share, marking a decline of 2.01% during the intraday session. While most casual retail investors looking at their mobile apps see a simple down day for a penny-adjacent tech stock, the real mechanics underneath this number point to a massive tug-of-war between institutional expectations and operating realities. While the broad narrative around residential real estate apps focuses heavily on high interest rates freezing the housing market, Opendoor just pulled off a quiet structural cleanup that completely subverts what the macro bears predicted. The company successfully stripped its aged inventory, meaning homes sitting on the market for more than 120 days, down from a massive 51% to a mere 10% over the last 2 quarters. This is its lowest level of stale inventory since the middle of 2022, occurring precisely while the rest of the traditional real estate market watched its own old inventory climb past 33%. The common belief right now among retail traders scanning various popular investing sites is that the iBuying model is fundamentally broken when mortgage rates hover near historical highs. People assume that if nobody is moving, a company that buys houses with corporate capital will inevitably drown under the weight of holding costs. This widespread assumption has kept the short interest elevated and the stock price suppressed in a tight band. However, the contrarian view that is starting to gain traction among institutional individual brokerage houses suggests Opendoor is quietly tuning its engine to operate profitably in a low-volume environment, effectively changing the unit economics before the broader housing market even recovers. When you look at recent trading volumes, which clocked in at 23.58 million shares compared to an average daily run rate closer to 36 million, it is obvious that big institutions are playing a game of wait and see. They are matching their moves with macroeconomic updates rather than blindly shorting the equity. This lower-than-average volume tells us the weak hands have largely washed out after the recent earnings report, leaving a more calculated tier of investors behind. The daily swings we are watching right now are less about speculative panic and more about how the market is absorbing the latest quarterly numbers and the federal interest rate trajectory. The corporate leadership team is sending its own clear signal into the market, trying to tilt that expectation versus reality equation in their favor. Just a few days ago, Chief Executive Officer Khosrow Nejatian executed an open market purchase of 100,000 shares at an average price of $4.88 per share. When a chief executive dips into their own capital to buy shares directly on the open market, rather than just accepting stock options as compensation, it forces institutional analysts to stop and rethink their downside models. It brings his direct ownership stake to more than 83 million shares, which is a massive personal bet on the operational survival and eventual scaling of this business model. This insider activity is layered on top of a highly complex first-quarter earnings report that dropped earlier this month. The headline numbers showed a significant beat on top-line revenue, coming in at $720 million against Wall Street estimates of roughly $666 million. That is an 8% positive surprise that caught a lot of short sellers off guard. On the bottom line, the adjusted earnings per share landed at a loss of 5 cents, beating the consensus estimate of a 6-cent loss. Yet the stock experienced a wave of selling pressure immediately following the report because the market is hyper-focused on forward guidance and the exact timeline for true net income profitability. If you trace the capital flows across major retail platforms like the Robinhood app or premium setups like the Interactive Brokers platform, you can see a distinct split in how different classes of investors are managing this risk. Retail accounts are frequently rotating out of speculative real estate tech and pushing funds into mega-cap names like Nvidia stock, Apple stock, or Tesla stock to chase clear, immediate momentum. Meanwhile, the specialized automated services like Schwab Intelligent Portfolios and managed small-cap allocations are holding steady on Opendoor, treating it as a highly reactive call option on a future housing market rebound. To fully understand why this price action is so volatile, we need to strip down what Opendoor actually does and how its core business model functions. The company operates a digital system designed to facilitate online investing and transactions within residential real estate, primarily using what is known as the iBuyer architecture. Instead of a homeowner hiring a local agent, staging the house, and waiting months for a buyer to secure a traditional mortgage, Opendoor acts as the market maker. They use algorithmic valuation models to pitch a direct cash offer to the seller, close the transaction in a matter of days, take ownership of the property, perform light renovations, and then attempt to flip the home on the open market for a margin. They generate revenue from the ultimate sale price differential and the convenience fees charged to the seller. The historical problem with this setup is that it requires an incredible amount of capital and exposes the corporate balance sheet to extreme asset risk if home prices drop while properties sit in inventory. The ghost of Zillow's failed iBuying experiment still haunts the sector, and it shapes the expectation that Opendoor is perpetually one housing crash away from insolvency. This legacy perspective is why the stock trades at its current depressed multiples despite pulling in billions in trailing 12-month revenue.
But if you look closely at the operational discipline showcased over the last few quarters, the reality of the business is diverging from that historical narrative. The corporate team has frozen fixed operating expenses at $33 million per quarter, which is down $6 million year over year. They are doing more volume with less internal overhead, proving that the tech infrastructure can scale without a linear increase in corporate headcount. More importantly, management has explicitly stated that on a forward 12-month basis, the firm is already adjusted EBITDA profitable, and they are targeting full adjusted net income profitability by the end of this year. Comment below how many shares of Opendoor stock you currently hold in your portfolio right now, or if you prefer sticking to broader market funds. The real expansion vector that the market is failing to price in correctly is the company's aggressive push into ancillary services. They recently launched a specialized mortgage product in Colorado that offers interest rates roughly 100 basis points below the market average. By acting as the lender alongside being the property owner, they are seeing attach rates that are significantly beating internal targets. They are currently pursuing mortgage and title licensing in more than 20 states, with plans to double that footprint by the conclusion of the third quarter. This pivot transforms them from a pure real estate flipper into a comprehensive digital financial platform, which could dramatically expand their gross margins per transaction. When you look at your choices for online investment, whether you are utilizing Fidelity Investments to buy Fidelity ETFs, researching self-investing options on specialized investing sites, or utilizing the simplicity of Robinhood stock trading for Robinhood fractional shares, the core thesis for a stock like this requires balancing macroeconomic pressure against microeconomic execution. If you look at broad choices like a Fidelity brokerage account or a SoFi active investing setup, most advisors point people towards safer dividend-paying vehicles or large tech equities. Speculative plays like Opendoor require a deep look at the structural catalysts on the horizon. The forward outlook for this equity rests on two distinct scenarios. In the bullish scenario, the macro environment begins to ease as interest rates stabilize or edge downward, unlocking a wave of pent-up housing demand. As transaction volumes rise nationally, Opendoor can leverage its new lean house structure and its expanded mortgage products to accelerate home flips, driving rapid revenue expansion and validating the insider buying we saw from the CEO. Because their old toxic inventory has already been flushed out, every new home they buy under current market conditions carries a cleaner risk profile and a healthier projected contribution margin, which management expects to settle comfortably within their 5 to 7% target range. Conversely, the bearish scenario cannot be ignored. If inflation data remains sticky and mortgage rates move higher, the residential real estate market could see an extended deep freeze. Even with a lean cost structure, if the total addressable market of willing home sellers shrinks too far, Opendoor will struggle to source high-quality inventory at predictable prices. If their mortgage attach rates slow down in tandem with a broader credit crunch, the path to sustained net income profitability by the end of the year could slip out of reach, forcing them to rely on their existing capital reserves and potentially diluting shareholders down the road. When you evaluate the options across major platforms from Robinhood crypto and cash management tools to high-end setups like Fidelity Wealth Management or individual brokerage accounts at specialized firms, you have to look at asset allocation through the lens of calculated risk. Opendoor is not a set-it-and-forget-it core holding like a standard index fund. It is a highly sensitive vehicle tied directly to the structural plumbing of American real estate automation. In summary, the central tension dictating the trajectory of Opendoor Technologies is the sharp divide between what the market expects based on past housing cycles and what the company is delivering in terms of operational execution. The market looks at a real estate sector weighed down by macro pressures and expects a capital-intensive iBuyer to falter. The reality on the ground shows a management team that has successfully cleared away its stale inventory, trimmed its structural overhead, expanded into higher-margin mortgage lending, and initiated meaningful insider buying. Whether this operational pivot can completely outrun a tough macro environment remains the ultimate question, but the structural transformation achieved over the last 2 quarters has fundamentally altered the risk profile of the business, establishing a deep baseline of authority for patient investors watching the tape. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.